Well, hello everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Well, to start this week, a couple things. First, I want to say, I remember I brought up that last Thursday, our program last Thursday was on opening day for Major League Baseball, except for those couple of games in Japan with the Dodgers. But last Thursday was the official opening day. Of course, I was mentioning that I was a miserable Angels fan, given that they've been not a very good team the last several years. But guess what? After the first week, they're 4-2. So pretty happy about that. In addition, of course, today the big news is the wild financial markets. The stock market sold off really big time, and we did see a pretty healthy improvement in bond yield. So with that, let's go ahead and get right into an interest rate update as well as what's going on in the bond market. First of all, our rate grid. What you're going to see is we had some pretty nice improvement today in rates, conforming loans all the way down to 6.125. FHA, VA now around 5 5/8. Heck, we can even do a jumbo, $1 million 7-year fixed arm at 5 7/8. So those interest rates are looking pretty darn good. And of course, these are where they're at in large part due to the movement today in the bond market in general. The reduction in the 10-year bond yield was particularly strong. Mortgage-backed securities, not quite as much, but enough that we saw some improvement in these rates. So when you look at the bond chart, it certainly shows or depicts the kind of chart, the kind of trend that we like to see. That upper end last Friday, again, this is a 5-day chart, nice gentle slopeward downward all the way to today. We're just a little bit over 4%, about 4.03, as you can see there. So that's what we like to see. Now, we'll see if this stays for an extended period of time. I have my doubts. Again, one of the things you'll see on our slides, we talk about the financial markets respond with reptilian-like minds to stimuli. I think today is a good example of that. Yesterday we had Liberation Day. Well, today, of course, it looks like people are being liberated from their strong profits from being invested in the stock markets. They're getting liberated from those profits as some of that turns into losses with that big sell-off. But I think it's a pretty strong reaction. I think it'll settle down, and then we'll see where the 10-year goes from here. What's going on in terms of the markets this week beyond the drop in the stock market today? Well, of course, the biggest issue is tariff uncertainty. That's what's driving all of this. That's what's driving today's financial market reaction, is this Liberation Day where the administration announced their new tariff policy. Other things did happen this week. ISM manufacturing came in a little bit under forecast, so that was soft. Under 50% is considered a contractionary type of a market. JOLTS, the job opening labor turnover, slight drop in available jobs of 7.6 million from 7.7. ISM services, again, a slight drop was forecast. That did prove to be the case. The remaining economic data for this week comes out tomorrow. It's the employment report. The employment report is projecting an increase in jobs, but a smaller increase than the previous month in February. And also that for the unemployment rate to remain unchanged. That's the forecast. So we'll see what happens tomorrow. I think regardless of the number, the reaction today in the financial markets, the bond market, as it relates to the tariff policy announcement yesterday, I think that's really going to carry the most weight, obviously, up to this point this week and probably through tomorrow. So that's where we're at. We'll see if this thing settles down once this news settles in. So with that, we're going to bring Jeff in because we got a few things to talk about in particular as it relates to is now a good time to buy a new home. Hi, Jeff.
Hey, Art. How you doing?
Doing all right. Just watching the wild and woolly stock market.
Man, oh man, I just looked at it. It's like, wow, it is. It looks like the bond chart. It's on a very steep hill on the way down. So it's quite a correction, and across the world, it's everyone is experiencing this. So it is causing ripples. I guess it's like that thing when the U.S. burps, everybody else gets a headache. So
exactly
here we
right.
go.
Yep.
Well, I want to kind of bring things back to home, because one of the things that we see, and you just showed it in the bond chart, is the rates have gone down and the rates themselves. And so I want to ask, hey, Art, is now a good time to buy? We keep waiting. I was up late last night. I was up early this morning. I'm looking at them. I keep thinking, and I didn't want to send any messages too early this morning. I'm like, are we going to break the 3 barrier?
Well, yeah, it's interesting because we've been saying now is a good time for a long time, and of course, now is a good time to buy. That call to action, if you will, I think it lacks a little bit of credibility in recent years. I think in the real estate world, folks, consumers perceive, real estate agents are always going to say now is the best time to buy. But given, the difficult couple of years we've had coming out of the pandemic, with rates having shot up as much as they did and home prices having shot up as much as they did, I think we've settled into a period where things have stabilized. And I think stability brings more certainty, and that I think makes people more comfortable with the potential, major, life decision like buying a home. So I think the current environment has slowly kind of evolved to the point where things have gotten pretty stable. Of course, hard for me to say that given what happened in the stock market today, but overall things have been relatively stable, certainly on the interest rate front. And while home prices have continued to creep up, the rate of increase has moderated. So I think put that together, and I think it really is a pretty good time to finally get off the fence.
One thing that I was just listening to an economist earlier today, and they were talking about inflation and the fact that we have been known as a country to create our own inflation by printing more money.
Right.
And they said, if you just think about saving money as an answer for your retirement, you'll never get there. They said the thing you need to have are assets. And of course, the number one thing they said is you need to be buying a home, because it historically has really never let you down. It continues to beat inflation. And as you've pointed out in the past, it's quite a wealth builder.
Well, it is. We've talked about it before. It's, as I think the numbers proved out, the Fed looks at this every few years, is that, the net worth of a homeowner is going to be something like 40 times that of a renter. And, it's not like real estate isn't without some risk. Obviously, everyone still remembers '08. But overall, it really combines a couple of things that I think are pretty important in somebody's, lifetime. You need to have shelter. You need to have a roof over your head. And you want to try to, accumulate some assets that are going to grow over time so that you're going to be able to start building wealth and prepare for your future years and your retirement. And what better way to combine those two goals than home ownership, because you're getting that roof over your head that you're going to have to pay for anyway, but with the added potential, I'll call it, it's not a guarantee, but a potential, and a pretty reasonable, and I think a pretty likely one, the added potential that by owning that home, you're going to start the path toward building wealth simply by nature of the fact that that home is most likely going to grow in value over time. And as you're making those payments, unlike a rent payment, you're paying down that balance that's creating more equity as well. So the combination of those two things is what really kind of creates this fairly clear path toward wealth build up, wealth accumulation that you just don't get when you're a renter.
This last little bit that this economist was talking about is buy that first home, and then as your equity grows, take that equity out and go buy income producing real estate. And you have coached on that, for quite some time now. When we were talking about all this equity you have in our homes, one of the things that you mentioned was, hey, go buy some rental properties.
Well, that's exactly true. And I've got some clients like that. I've got a customer right now who, and this is a person who's relatively young, certainly compared to, say, somebody like me, or maybe even you, Jeff. But
I didn't have you didn't have to go there, but okay.
Yeah. But after purchasing his first home, a couple of things about this particular individual. I mean, happened to have an opportunity to own a condo while he was going to college. Well, of course, as he got older, got out of college, he kept that and turned it into a rental. Then got married, bought his first, primary home after college. And then eventually after that, pulled some equity out. Long story short, he now owns, besides his primary, about to own a total of 8 units of residential real estate, income producing property. So that's an example of what you can do if you can be focused and realize that, again, home ownership is a pathway toward wealth accumulation.
I think that's great. Well, I want to bring up something that you shared earlier with me, and it was a document, Residential Real Estate Council Mortgage Rate Affordability Index, or MRAI. Both are a little bit of a mouthful, but I
Yeah.
want you to share. What does that mean, and how is it going to help the average buyer out there?
Well, yeah, this caught my eye, and so I wanted to share it with our viewers because I thought it really hit home on really a message I've been trying to convey for a long time, that we've been trying to convey on the show, about the fact that, relatively speaking, interest rates are not as horrible as everyone would like to believe or describe. So this entity, this organization, came up with this methodology to try to, I guess, bring to current people's perspective on interest rates, mortgage rates, and are they truly unaffordable or not, at least historically speaking. So the way this index works is, first of all, they looked at what's been the average mortgage interest rate for 30-year fix in the U.S. over the last 50 years. And this would be, using a Fannie Mae, Freddie Mac, conforming conventional loan is the type of loan we're talking about. Well, as it turns out, it's about 7.74%. Again, that's the average 30-year fixed rate mortgage in the U.S. over the past 50 years, average of 7.74. Well, this article pointed out that current mortgage rates at the time it was written, they quoted, was about 6.74. And of course, we were lower than that when I read this article. It was about a week ago. We were more like 6 3/8. But the point is that what this index is, it's a mathematical calculation. So what you do is you take the MRAI is going to be the 50-year average rate, 7.74, divided by today's rate. And what Jeff just pulled up, I used our rate yesterday, was 6.375. So take the historical rate, divide it by the current market rate, times 100. In this case, the example, it's 121.4. What's important about that number is if it's over 100, that resulting number, that indicates that current mortgage rates are affordable, at least historically speaking. So again, here, as Jeff pointed up, scores over 100 means that rates are more favorable than the historical norm. The other thing to understand about this index and how it's used, buyers waiting for 3% to return. You're waiting for an anomaly, hard to say that word, anomaly, not reality. And now is still financially favorable to buy. I know that sounds hard to believe, but that's what this index is telling you. It's creating a new perspective as to mortgage rates, and are they really that bad or that good compared to historical averages. And what we hope to do by sharing this with you is hope that you will see the bigger picture when it comes to mortgage rates. Because, understand that, again, as we talked about earlier, home ownership accelerates building wealth compared to being a renter. Yes, you can build wealth as a renter if you do the appropriate things with your money and invest it wisely to generate a return from alternative assets and owning a home. But for the vast majority of people who don't have the discipline as a renter to do that, home ownership is what's going to accelerate yourself building wealth for you and your family. You grow equity every time you make a monthly mortgage payment. You don't do that with a rent payment. A monthly mortgage payment builds equity every single month. Home values do continue to rise. They've continued to rise through this last couple year period, despite predictions that they'll fall because of higher rates. That hasn't happened. Inventory is still relatively low. And so, again, you can take advantage of that if you get into buying a home now. And then you always have refinancing as an option after you acquire that home at current interest rate levels. Recent projections are you're going to have to wait a little bit longer, maybe a couple of years, 2 to 3 years, before you see those rates low enough to do a refi. But in the meantime, you have these other benefits that you should take advantage of now and not wait any longer.
Well, Art, I just want to ask you a question before we go into the next slide. Is, let's say for those people that, since you bring up the 3% rate to return, those people who have been waiting on the sidelines thinking they're just going to wait for those low rates to return before they jump in, what's that really costing them in the long run when they, you talk about, monthly, accumulation of value in a home. Doesn't that make the gap just that much wider?
Well, of course it does. I mean, think of it this way: like here in my local market here in the Coachella Valley. Now, this is across all 9 cities. Our median home price is about 600,000. Well, and I think the latest numbers, and again, these are national numbers, but I think the market here would support this. Homes are continuing to appreciate, most recently at about a 4% annual, rate. We'll take 600,000 at 4%. Well, I mean, you're talking about what, $24,000, right? So the point of it is, you buy a home, and if you're willing to accept that homes will continue to appreciate at 4% a year, just the fact of acquiring that home in that first year, you're gonna earn potentially $24,000 of equity that you didn't have before, and that you wouldn't earn if you were a renter. Not to mention the fact that 24,000 is just on the market appreciation side of the equation. As we pointed out in one of the bullet points, as you make payments on that loan, you're paying down the principal, which is also adding to the growth of equity. So you're attacking it from both sides: market appreciation, and then equity buildup by reducing the loan balance through your monthly payment for your housing, that roof over your head that you would have to pay anyway if you're paying rent, without that added wealth generation benefit.
When it comes to the home ownership, there's still this mindset, this gap of, well, I'll wait till the rates come down, and hopefully that means that the prices, we've talked about this, of the inventory levels are going up, so there's the potential pressure for it to go down. But what does that end up doing when we simply talk about it? You talk about it, Econ 101 is supply and demand. What does that actually do then in the case of the buyer?
Well, see, I think the buyers who have been thinking that way, I think they've hurt themselves, because of the fact that, yes, there's this belief that if homes are selling at a lesser rate, that I'll call it a normal market, would tend to generate sort of almost get to a point of a glut of listings. Homes are not selling, even though there's a large supply of homes listed for sale. In the environment we've had the last couple of years, I've never seen this combination of factors before. We had rates more than double, which did slow down home purchasing quite a bit, but that didn't lead to a significant growth of inventory, because so much of the current housing stock never put house or considered putting the house on the market because they already refied at that 2.5% or 3% rate. So you had this combination of rates have doubled, home prices went up by a bunch as well. So home purchases slowed, but without the corresponding increase in inventory to help moderate the home values. And so we had this weird situation. Rates doubled, home prices already shot way up, and they continued to go up since then, even though we've been at these elevated mortgage rate levels. What I like about this index, once I heard about it, was it brings some perspective back to realize, the pandemic, 2020, 2021, those 2% and 3% rates, that was not reality. That was a, anomaly. And it will probably never return in our lifetime. So we got to forget about that and realize that historically, on average, we're actually better off rate-wise than we were historically on average. So it's like, so of course, I'm the mortgage guy, so that's why I say, aha, see, this is another reminder. It's not about the mortgage rate, it's about the home price. It's the home prices, I think, are the real problem, and the lack of inventory of homes for sale. That's where our problem is as it relates to affordability.
Let's talk about those people who have, like the news that you're sharing is a bit of a breath of fresh air, and it's almost like the starter at a race. They've shot the gun. It's like, okay, let's get back in the race. What strategies or combination of strategies could you offer those people coming into the market to make a decision? Because I know your business is dependent on the real estate agent bringing you a buyer. or the people who say, hey, before I go out and get a real estate agent, I'm going to get my mortgage house in order and get pre-approved before I go out and do anything.
Mm-hmm.
What advice would you give them, and what strategies would you share with them that would help them really get a jump on the market conditions they are right now here in the Coachella Valley in Southern California?
Well, I'm trying not to chuckle too much, but anybody who watches the show, I think, is going to guess what I'm going to bring up, and it's buy downs. It's realizing that if interest rates are a concern, even though we've now shown you that interest rates historically are more affordable than they have been historically, but it's still a concern. What you want to do as a prospective home buyer is realize that the old sort of strategy, the old tired strategy, I call it, of you see a home for sale listed for 30, 40 days, no offers, hasn't had a price adjustment. You think, okay, opportunity, I'm going to go with a below list price offer and try to get a better deal on the price. I think that's sort of outdated, worn out thinking. If you're a seller, you've had your home on the market for 30, 40, 60 days, you haven't had any takers. You're talking to your listing agent about, well, maybe you're going to have to make an adjustment. What do you typically do? You adjust the price lower. We're seeing more and more of that. Inventory, certainly in the local market here in the Coachella Valley, I think in Southern California in general, inventory is growing. It's up to like 4.5 months plus. So it's getting closer and closer to normal. We are also seeing a little bit more of a gap between original list price and closing price. There's a couple of percentage, 2 or 3 percentage points in there, sometimes in some markets as much as 4. That's opportunity. So what that tells you is use interest rate buy downs as a strategy. Instead of offering 4% below list price, offer full price, ask for that 4% in dollars. We can then use that for a temporary 3-2-1 buy down and probably cover a good portion of your closing costs as well. Or if you don't have, you don't think the room to ask for a 4%, ask for 2 or 2.5. We can do a 2-1 buy down, maybe have some money left over to cover some of your closing costs. Now, the other strategy as it relates to buy downs that I haven't talked a lot about is permanent rate buy downs. Instead of doing a buy down that's temporary for 2 to 3 years, where on a 3-2-1 you could start in the 3s, on a 2-1 you can start in the 4s, maybe taking and still asking for in your offer, go full list price, but ask for dollars as a seller credit. Use that to permanently buy down your mortgage rate. And in fact, what you can find is you're going to be able to lower the rate on that loan. If we're currently, yesterday we were at 6 3/8, you could ask for a seller credit that would be equal to what it would cost to get a 2-1 buy down. With that same amount of money, you can simply get a reduction in that note rate by about 0.5%, from 6 3/8 to 5 3/4. Or if you ask for the full amount that you would need to do a 3-2-1, instead use that for a permanent rate buy down, you could take that rate from 6 3/8 down to as much as 5 1/4. And that's for a 30-year term. Plus the benefit of a permanent rate buy down over an temporary interest rate buy down, you do get to qualify at that note rate, which can make a difference if you're a little bit tight on qualifying. So I think the buy down strategies now, even more than before, are the way to go to take advantage of these conditions.
You've talked about it. I know you've shared instances over the last 6 or 7 months where you've had customers who come in and you said, hey, could we look at this other idea, the buy down? And they were like, yeah, let's do it. And they've closed their deals. But that's not an uncommon thing for the new home selling business. And I remember we talked about, some of the home builders said that they are really, leveraging up the buy downs because they're trying to sell more homes.
Well, exactly right. In fact, I just read an article on the business page. I think it was the CEO of Lennar Homes, talking about their I think quarterly report or something, their numbers, and on some sort of conference call. And one of the things they pointed out was how they've had to ramp up even more the various incentives they're providing to home buyers to get those contracts written. So what that's done is it's helped prop up their sales rate. And in fact, I think their sales rate is even slightly up, but it did come at the expense of some higher marketing costs. And he pointed out a good chunk of that is as a result of the incentives they feel they need to offer to keep that sales rate up. And of course, a major part of the incentive options they provide have been money for buy downs, both temporary and permanent buy downs. And I'm working on one just now. I'm a backup lender for a Southern California home builder, and oddly enough, the development's a condo development up in Northern California in Morgan Hill, and I'm now working on one of those buyers. I'm going to be arranging an FHA loan for them, believe it or not, for a $900,000 condo. And they started with the primary lender at that development. I'm the backup, which is B of A. And I guess they weren't happy with what they were offered. So when they came to me, they're going to get a $30,000 credit from the builder.
Wow.
And so what I did, I asked them how were they going to use it. And they said, well, they didn't know. They hadn't gotten that far. So what I showed them is with $30,000, I'm going to be able to get them an FHA rate at like 5 3/4, do a 2-1 buy down. So the first year they're at 3 3/4, second year 4 3/4, third year through 30th 5 3/4, and there'll be money left over, about $11,000 left over of that seller credit to be applied toward their closing costs. So the net result is they're going to be able to buy this $915,000 condo with a first year rate at 3 3/4, and with the total cash out of pocket, including the down payment and their net costs after the seller credit, of $40,000.
Wow.
So you're talking about almost $1 million home that you can acquire with $40,000 out of your pocket and have a first year mortgage rate at 3 3/4.
Wow.
I don't know. That sounds like pretty good terms to me.
Yeah.
Or alternatively, I could have used that money and bought down that 5 3/4 rate to probably 5 1/4, 30-year fixed, below market. Either way, I mean, those are just phenomenal terms to buy a nearly $1 million condo with minimum cash out of your pocket, and you're going to have rates in the 5s.
Well, I'm curious. Yeah, I think that's just amazing to be able to do that. And then also, I want to bring up something you've shared with us. You've got a little bit of a scenario here for us, and I want to talk about the strategy of a temporary versus a permanent. And this is what you guys said. Assumption is the purchase price of a home is $750,000 with 20% down for a loan amount of $600,000. Assume the note rate is 6 3/4 or 6.375 with no points or origination fees. And just kind of walk us through this. So here it is. It's a 2-1 rate buy down versus a permanent rate buy down. Talk us through this.
Yeah, with this one, what I'm showing is with 2 ways to request a credit from the seller in dollars to be applied toward one of these 2 options. So what I did here is for the 2-1 rate buy down, first thing to do is calculate what the cost of the buy down is going to be. And I did that, and the cost comes out, it's about 2.2 points. And what a 2-1 buy down does is it gets you 2% below the note rate the first year. So you see 4 3/8, that's your first year rate. Your second year rate is going to be 5 3/8. And then your third year rate through the 30th will be the 6 3/8. Now the cost of that 2-1 buy down structure is about $13,571. So then what I did is I said, okay, let's assume the buyer doesn't like that temporary buy down structure. And they asked me, well, how much can that same cost result in just permanently buying down the rate for the entire 30-year term? So you see that on the right, permanent rate buy down, take it from 6 3/8 down to 5.75. It'll be 575 for the entire 30 years. The cost is $13,500, comparable to the 2-1 buy down. So this way, the buyer can see both options. Do I want to take the higher note rate, but have it subsidized for 2 years, and then end up at that 6 3/8 for 28 years? Or do I better like the idea that I don't think rates are going to fall a whole lot in the next few years, so I don't see a refi opportunity in the short run. I'd rather get the lowest I can for the whole 30-year term. So they say, never mind about the buy down. I'm more interested in getting that note rate as low as possible. So for the same cost, I'll take the 5 3/4. The added benefit is the permanent rate buy down. You get to qualify at the 5 3/4 in
Oh,
terms of your debt ratio. With a temporary buy down, as I've said many times, a temporary buy down is not a qualifying tool. You don't qualify at that subsidized first year rate. You qualify at the note rate. And when I say
so
qualify, what's
I,
that?
I was just going to say, so what you're saying is that 4.375, I'm not qualifying for a note at that rate. I'm still being qualified for the 6.375. In other words, saying, hey, you can afford it when it goes to that rate.
That's
Is that
correct.
right? Okay.
That's always been the way this works. Is that the temporary buy down, because of the fact it's temporary, right? The rate's temporary. It's not going to be there for a very long period of time. So you want to avoid this. In the industry, they call it payment shock. We don't want to see people qualified at 4 3/8, and then 2 years later they've got payment shock because they really didn't qualify for 6 3/8. And when the payment gets to that level, suddenly they're having trouble making the payment, and they can go into default. So temporary buy downs are never used for qualifying. Your debt ratio is going to be calculated off your note rate, not your first year rate. The permanent rate buy down, because there's no temporary to it, it's permanent. You are qualified. Your debt ratio is calculated off of that lower 5.75 rate. So that can help you. Let's say you're right on the edge on debt ratio. You're at 49.99. You might be better off to take that permanent rate buy down to get comfortably under there so that you're not in any danger of not qualifying based on debt ratio. So, and then we've got another example here where I compared the two for a 3-2-1 buy down versus a permanent rate buy down. So with this example, you see 3 3/8 the first year on the temporary, then 4 3/8 the second year, 5 3/8 on the third year, and then 6 3/8 for year 4 through 30. The cost of that is right around there. You see it, $26,659. So the alternative again. You don't think rates are going to fall a whole lot. You want to get that note rate as low as possible for as long as possible. Take that same cost. Don't do the 3-2-1. Just buy down the rate permanently the entire 30 years. So now you're taking that note rate from 6 3/8 down to 5 1/4. And that's a 30-year fixed rate, never going to change. That's a big help qualifying wise if you're in trouble on debt ratio. Unlike the temporary buy down, doesn't help you qualify at all. But that permanent rate buy down, particularly if you're able to get enough dollars that would normally cover the 3-2-1, great strategy to use it for a permanent rate buy down. That way, it really helps qualifying wise if you need that help. Otherwise, you just got a very low rate and a lower payment for that entire fixed period.
Now, Art, is there a if you're consulting with people and guiding them, that is there a reason why I wouldn't do the permanent rate buy down versus the temporary? I mean, is it like longevity if I'm in the military or maybe I'm transferring things? Does that play into it at all?
That could be part of it if you just don't think you're going to keep the loan past maybe 2 to 3 years. I think the other thing that was appealing to borrowers about the temporary buy downs is when there was stronger talk, I would say, of rates were going to fall substantially in the next 2 to 3 years. So the thinking would be, well, yeah, I could take 5 1/4 now, but if I think I can get enough concession out of the seller to pay for a 3-2-1 buy down, 3 3/8 for a year, 4 3/8 for a year, I like that better because I think by year 3, mortgage rates are going to drop from the low 6s to 5%. So why not take advantage of the lower subsidized rate the first couple of years? Because I think I'm right that mortgage rates in general will be at 5 or below by year 3, and then I'll just refi out of it. If you don't have that belief, and I would say more people no longer believe that. Again, we've talked. Fannie and Freddie say mortgage rates are going to be in the 6s for the next 2 years. So the idea of waiting for rates to get into the mid 5s, low 5s, into the 4s, that's probably 3-4 years away. So when you start thinking about it from that timeline, that starts to move the needle more toward maybe that permanent rate buy down is not a bad idea.
So, Art, when we look at these scenarios, the 13,500 or the 26,659, So that is asking the seller to have a concession, and is that possible in today's market?
It is, and many, a lot of the transactions I'm working on today do involve these kinds of approaches. Um, yeah, I mean, these cost numbers we're talking about, this would be a case where, again, my recommendation would be, if you're looking at a home where you think you want to, let's take the 2-1 buy down example. You're looking at a home where you think you can offer 15,000 below list price. My argument is, don't do that. Offer full price. Ask for 15,000 seller credit. Then you can use it for that 2-1 buy down or that permanent rate buy down, either or. And you'll see that you have a few dollars left over, about 1,500 or so, that can be applied towards your other closing costs. Alternatively, look at the 3-2-1. You're looking at a listing. It's been on the market 40 days, no offers, no price adjustment. It needs to get a price adjustment. You're thinking, talk to your agent. It's at 750. We're going to offer 720, 30,000 below. Don't do that. Offer 750, or at least don't do that until, let me show you the number based on offer 750. Ask for the 30,000. Then we'll apply to that 30,000 to one of these 2 buy down scenarios. And there again, you have about $3,400 left over towards your other closing costs. So at least look at that first before you just knee-jerk decide, here's an opportunity for leverage. I'm going to, offer 30 grand below list price. I say don't. Offer full price. Get those in dollars. If you're going to use a loan to finance your purchase, get those concession dollars as dollars, not in price, and then use it towards your loan. It's much better off.
Haven't you told us before, like for every $1,000 you get off a price, it is so minor as far as adjusting my overall monthly payment?
At these rate levels, it's about $6.5 a month. Because I'll show somebody a payment at, I don't know, pick a number, $2,500 a month, principal and interest, and they'll be kind of disappointed, and they'll say, well, what if I put 10,000 more down so that they're not borrowing as much? I'll put 10,000 more down, and then I do the math. It's like, well, how much does that improve my payment? $60. And they're waiting for me to say 300, right? That's why when people tell me about, like, if they're having trouble qualifying based on debt ratio, they're like, well, what if I put more money down? That's probably the least effective way to reduce a debt ratio. In those circumstances, the problem is almost always on the debt side. So don't worry about putting more money down. If you had the money to put more money down, don't put it toward the down payment. If you have other debt that's keeping you from qualifying, use that money and pay off the debt. That's a much more effective and powerful way to get your debt ratio in line than just putting more money down.
I have one last question. I'll let you go. You haven't really ever spoken too much about permanent rate buy down. It's always been temporary. What's been that triggering effect for you to even consider or now talk about that? And I see it could be a very viable option, but why is it now and it wasn't, say, 3 or 4 months ago?
Well, I think a couple of reasons. One is, rates in general have gotten a little bit better. That's helped. And, frankly, for me, I mean, I'll admit it, at times I react to what the market's demanding. And I've had a couple of purchase scenarios lately where, again, I always bring up this buy down strategy when the agent and the prospective buyer is asking me to put together a pre-approval letter. And once I learn that they're going to ask for a concession, I have tended to offer the 3-2-1 buy down, in part thinking psychologically that's powerful because you can bring them back to the old days of the 3% loan, right? At least for the 1 year. More recently, what I've realized is that that's not for everyone. And in some cases, the buy down can play a role in helping somebody qualify for the loan. And that's particularly important if you're talking about a home where the buyer needs an FHA loan and if they have a lower credit score. If you've got somebody with a 625 credit score and they want to put 3.5% to 5% down, they will get clobbered on rate if they try to do a conventional loan. It's available, but the rate's going to be way up there, like high 7s, close to 8%. I can arrange an FHA loan for somebody with a 625 credit score with 3.5% down and get them a rate of 5 7/8.
Wow.
And that's with no points. And then if they're a little bit tight on qualifying, that's where, the 3-2-1 or the 2-1 doesn't help them. you're better off taking those dollars, taking that 5 7/8 FHA rate, take it to 5 1/4, or 5%, depending on how much seller concession you can get. That's powerful because we're going to qualify them off of that 5 1/4 or that 5% instead of 5 7/8. So if they're on the edge on debt ratio, that's a reason why a permanent rate buy down is the better option. It gives you the nice combination of below market rate for the entire life of the loan, but the ability to qualify for that more easily, and that could make a difference in being able to buy the particular home you're looking at. So
I love it. I think that makes perfect sense. Well, Art,
yeah.
Thank you very much. This is a great piece of information, a great show today. Any last thoughts before I bail out of here?
No, again, we'll see what comes tomorrow with the financial markets and the stock market. Again, there's tariff turmoil anyway. I think ultimately things will settle down and we're all going to survive this. In the meantime, I keep saying it. It's true. You got to believe it. Conditions have gotten better. Rates are very good right now. We're fingers crossed. Maybe we can break that 6% level and get into the high fives. Let's keep an eye on that. Hope it happens. And even if it doesn't, at these levels, you really need to jump in, buy a home if you've been thinking about it. All right, everyone. I want to thank you for watching and listening to this week's Mortgage Minute. My name is Art Alvarez at Mortgage Works, where we have the answers and they're on the house. Look forward to seeing you next week. In the meantime, keep an eye on that Final Four and the National Championship basketball, college basketball next Monday night. Again, have a good weekend. So long. Take care.